Welcome back to the channel. I'm Foreman, and in today's video we're going to be talking about quite a few different stocks as well as the UK stocks I'm buying right now. I'm talking about Diageo, Unilever, TinyBuild, YouGov, Ocado and also Boohoo, so make sure to stay tuned if you're interested in these particular stocks. As for my portfolio, it hasn't done that well, but I think it's not too bad considering. This week it is down 1.87%, which I think, to be honest, is probably the least volatile week I've had in the last year. I don't even think I'm wrong in that remark. For instance, the last day of trading being Friday, in fact, my returns were 0.1%, which is phenomenally low considering, but on the actual chart, my portfolio was up and down the whole day. It just suddenly, by luck, if it really matters, balanced out at the end. But when you compare to the FTSE 100 and the FTSE 250 that are both up in the last week, the S&P 500 and the Nasdaq I'm definitely closer to. I outperformed the Nasdaq 100 this week, but it's hardly like I'm outperforming it long term at all. But I did underperform the S&P 500. And I've been changing or thinking about the ways I'm going to alter my strategy going forward, but I'm not going to implement the changes to it just yet. At the moment, I hold Boohoo and Games Workshop in my ISA portfolio. In a secondary portfolio, my SIP, I hold Dunelm Group, London Stock Exchange Group, Redrow, and also Sylvania Platinum. I think a blend or some form of diversification should be found because at the moment, growth stocks are out of favour. Both of my companies in my ISA portfolio are therefore dropping, which is fine because it means I can take advantage of the dip. I'm still making money, and I expect that I have a career ahead of me, meaning that I could therefore use future potential earnings to continue buying stakes in these companies. However, what I would like to do is that once the growth stocks have started to recover, I look towards building perhaps a cash position. I should start looking towards a few. I'm saying a few as in like 2 to 3, possibly more holdings that have different styles. So for instance, we would consider Boohoo a high growth stock. Yes, obviously they've fallen out of favour at the moment, so maybe they're a little bit more of a turnaround growth play. But for instance, that's what they are. Therefore, the risk is on. There's a lot of volatility. Whereas I think maybe I should have some room for just the stalwart, as Peter Lynch would say in his book One Up on Wall Street, where the growth is for the most part is behind the company, but they pay an attractive dividend, and you know that it's not going to go away anytime soon. And I'm thinking about like Dunelm Group with that. I hold it in my SIP. I quite like the company. Obviously, it does have growth ahead of it, but a nice blend. I think a good mixture of a good dividend payer, but also one that's going to be a little bit more consistent than the rest of the holdings. And then that hopefully would add a bit of a balance over time. And then I could start diving into different styles such as turnaround plays or purchasing a stock based on its asset value and whether I think actually it's very undervalued compared to the share price and that the assets on the balance sheet aren't actually noticed. But I'm certainly going to stick with my strengths for the moment, buy the dip in the growth stocks, which is what I'm doing, and I will continue to do that until I see a healthy recovery in the shares or the story changes in my holdings. So the first item of news this week is Boohoo has had some direct dealings. On Twitter, I made the immediate mistake of thinking this was just a buy. However, this is an execution of a contract. So what had happened is Ian McDonald, he had simultaneously terminated the contract with 300,000 shares. So what has effectively happened is he has bought 300,000 shares at 103 pence and sold it at the same time. Now, I understand this is likely due to the fact that he's taking some of the money out, and obviously he has another option coming up, so why not, right? But also at the same time, it's neither good nor bad. Well, I should say it's more of a positive than a negative. You might go, well, his overall position stake is the exact same, so how is this a good thing or a bad thing? Well, when you think about it like this, it's acquired via contract for difference. But the way it's done, yes, sure, he's terminated 300,000 shares, but you, as a large majority, would expect insiders to be eventually selling down. Insiders can sell stakes in the company for many different reasons. However, they only buy for one. This contract was continued and re-executed at the same volume as the previous one, suggesting that Ian McDonald believes there's further growth in the future of this company, and I would say that is more of a bullish sign than it is a negative. But overall, I suppose it isn't that much of a sign at all, but it is worth mentioning. Boohoo's share price this week has been not very volatile. It's up 3.34%. You compare it to 6 months ago and we're still down 61.59%. I'm happy to continue buying with dip, in which I can't actually remember how many shares I have, and I can't also tab back out. Let's have a look. How many shares did I buy this week? Let's total it up. So here to here, I have bought a total of 370 shares this week. Freetrade PLC, they make premium carbonated mixers, so you might be getting a gin and one of their tonics, for example. They've had their full year or financial year 2021 trading update, and they have said that their revenue in the UK has grown by 15% since last year. Last year was a one-off year. They'd done quite well from it, so to see extended growth from that is a great sign indeed. They've also had a growth of 33% in America and 34% in Europe, their total revenue increasing by 35% in Europe, with their overall revenue for the entire group increasing by 23%. Some very solid figures indeed. So I'm going to skip down a bit. Hopefully there is some financials down here. Apparently not as much. I was looking for perhaps some financial statements that would give a little bit more information, but effectively they've done quite well. Apparently they are the #1 ginger beer brand at retail in the US, as well as being the #1 tonic brand at retail in the US, which is a great sign to see that their brands are seeing more recognition and doing quite well. I'm pretty sure they said elsewhere as well that they did reach other categories, but they've now got, where is it? Okay, I'm not too sure, but either way, it looks quite impressive. This is quite a good quality company. Their share price, however, in the last 6 months has been pretty savaged. In fact, you're down 12.75%, but from the last month, it is down quite an amount, such as 26%. You go back a year, even let's go 5 years, it's not really moved around much. Perhaps you could say it's overvalued, although I'm interested in this company and I think mixers are certainly going to remain in demand. But it's a question of saying, is it more of a cyclical stock? You can say food and drink are staples, but that doesn't mean they won't come and go in trends, especially when it's tied to the idea of alcohol. Yes, alcohol is seen as a staple, but what types of alcohol is interesting, because it might be, okay, yeah, people at the moment don't want to be drinking premium mixers because we're about to go into a recession. So this company could therefore be struggling. So that is worth keeping an eye on, for instance, but I think they'll do quite well indeed. I think their brands are quite popular, and it's very likely that you have come upon them before. We have Diageo relating to the alcoholic beverages industry. We have reported net sales of £8 billion, which has increased 15.8%, but their organic net sales has grown by 20%, which is phenomenal for a company of its size. They've said their operating profit has increased by 22.5% and their margin has increased by 190 basis points, which is good indeed. I believe they mentioned that here at some point, I hope. This is where the financial information is. Great. I believe they said that they'd taken up a little bit more market share as well, although I can't find that at the moment, but they have delivered strong net cash flow from operating activities, which has decreased 0.1 billion to 1.9 billion. But overall, the overall cash flow of the business being a roughly 1.6 billion being their free cash flow, that is a lot of money that they're able to therefore pay down debts, or perhaps if they want to make acquisitions with. So it is a very good sign indeed, and they've invested to sustain long-term growth, which means their organic growth in marketing investment of 27% ahead of the organic net sales growth. Quite promising indeed. Their shares have done very well in the last year, although in the last 5 years they've been quite slow. But then a company of a market capitalization of nearly £90 billion is obviously going to be quite slow. But this is the attractiveness in this kind of company. Diageo is not going anywhere soon. Don't get me wrong, that is a negative but also a positive. If you need a stock in your portfolio and you're like, look, what do I think is going to happen? I think people are probably still going to continue to drink alcohol. I think they've got a good position part of the market where they have a lot of the cheaper, more accessible spirits, as well as some of the more premium brands like Tanqueray Gin. So, therefore, I think they will do well in any sort of economic downturn or any sort of economic cycle, and therefore I put some money into it. I'm only speculating here. I'm saying this could be a good strategy in a way where you would hold a piece of Diageo, knowing that your capital isn't going to move up too much, and let's say it moves up by a smaller and a better than you may have expected, and you think it's getting a bit frothy, so you want to trim back, you could do that and you've got cash available. But at the same time, at least you know if, for instance, you were holding Boohoo and that dropped by 60%, at least you'd have Diageo holding quite strong at that point in time. Food for thought, in my opinion, as my strategy sort of adapts to the current markets. Although at the current price, I don't think I would be buying, but they are no doubt a quality company. Ocado is reimagined. They are taking the next leap in innovation. They've mentioned that their initiatives is the 600 series bot to be the world's lightest and most efficient grocery fulfillment bot. They've optimized the site design. They've now automated the frame load. They've got an on-grid robotic pick, which apparently picks and packs customer orders directly from the grid. They've also got Ocado Orbit, which I honestly don't know what this is, but it's apparently the first virtual distribution center which does not require a network of regional distribution centers to deliver products to the fulfillment center. And they've also got a few other things. Quite promising, certainly. This company is one that you would be purchasing not really for their retailing of groceries, but for the underlying technology that is actually used in their business, and I do quite like it. If you've seen videos, which I've not got on the screen, unless maybe the Ocado website can help us, where they have like videos of their factories, for instance, and you can see how they work, and they work to extreme efficiency. You literally just see all of these grids and boxes just moving about, and it all picks up everything that you need. And it is, honestly, I highly recommend taking a look, even if you don't really care about Ocado, for instance. Taking a look at that and finding out how they work, for instance, and seeing the warehouse really in action is quite a marvel of technology. And I think really that this kind of technology is going to grow. Retailers, for instance, are going to want to be able to deliver products more effectively. They want to obviously automate the process. It's going to have lower operating costs once they've got the facilities set up. You're going to need engineers on site, obviously, to maintain it. But aside from that, you're not going to have to worry as much about people in warehouses moving stuff about. Obviously, that's still going to happen here and there. But the idea here is if you get it fully automated, you would have a very attractive business. What's to say Boohoo didn't go? Boohoo couldn't go up to Ocado, for instance, and say, you know what, yeah, we would like your warehouse technology in for our products. Imagine how much quicker the delivery process may be. See, I don't know Boohoo well enough to know what they do behind the scenes aside from get the product, ship it out. I don't know exactly what goes on in detail, but if they had automated technology like this, if they're able to deliver products faster than their competitors, then they would have been seen as a much higher value for the customer that is purchasing it. So something I certainly like to look into. With that in mind though, Ocado's share price has not really followed the perhaps positive sentiment, and that may be because it was very much overvalued a year ago due to the hype of the pandemic. Shares are down about 48%, and this is pretty much since their all-time highs, I believe, but in the last 5 years they've done very well as well. So it's likely that they're coming back in line to find a more fairer valuation for the company. I think it is one to watch. I like to follow this company. The technology there is impressive, and it's good to see that we have got a company like this in the UK, because we do lack in these sort of, I mean, we do have a few hardware and technology companies, but we don't really have many, and this really has the chance to be one of the top dogs in the FTSE 100 over time, providing they are not acquired for whatever reason. We've even got YouGov. If you don't know of YouGov, they do a lot of the surveys. They come up a lot. Like their brand awareness is quite high, at least in the UK. And they've mentioned that their trading update is going to be slightly ahead of the board's expectations for the current financial year. I don't know the management well enough to judge whether that is usually where they may underpromise and overdeliver. So they may have actually done very well, but at the moment they're only saying it's slightly ahead of the board's expectations. So one also to think about. But they've mentioned that actually they've performed well during the period, with continued growth seen across all divisions and geographies, which is great, right? You want your business to be growing across all regions and also at each point. Fantastic. Obviously there is no true figures here, aside from the fact that they have entered into a new RCF, or revolving credit facility, with an initial drawdown of £20 million for corporate purchases. Again, something of note there. And that apparently they are pleased to report, their sales pipeline remains robust, giving them continued momentum into the second half of the year, and that they remain confident of achieving top line growth for the full year with their strategic plan. We've also had the news that Unilever is spinning off Ben & Jerry's into a separate unit and corporate overhaul. You might look at that and think, wait, they're going to sell Ben & Jerry's. Okay, the title of this is in a way misleading, or perhaps it's misleading if you don't really truly understand what the title is referring to, because spinning off could also be, yeah, I'm getting rid of it, I'm selling it. But in this way, they're saying it's into a separate unit, so you might assume that. And it's a good example of why you shouldn't just read the headline of an article and then inform your research or your investment decisions based on just that headline. Not something I like to do. It's very easy to be very prone to fear and excitement when you only read headlines. I like to really dive into it, work out who the actual author was, for instance, and really drill into them if it is of particular interest to me. But what has really happened, to skip this article is that they've actually simplified, or they're trying to simplify their organization. Because they're such a massive business, it obviously makes a lot of sense that they really want to simplify. I think before they were organized very oddly, but at least now they're going to be beauty and well-being, personal care, home care, nutrition, and ice cream. Therefore, they're going to have independent oversight, or at least in their own bubbles, I suppose, of these individual groups, and then they can effectively work on growing these products at a more focused sort of direction. Whereas at the moment, perhaps it's a case of, yeah, the CEO is overlooking everything. I mean, that's to be expected, and the COO is, for instance, but you might be going, okay, yeah, ice cream's doing well, but we really want to put our attention into this. Whereas if you have a dedicated team of management for each of these brands, they're obviously going to put a lot more effort in. And that's not to say they haven't got that already, which they definitely do, but to split it in 5 different business groups, it gives you more focus for each of them. You might be a pub group that's interested in knowing, right, you might be a restaurant and pub and hotel chain, right? You might want to go, right, how's the pub doing? How's the hotel doing? And how is obviously the food trade doing? So I think that's something of worth noticing, because if you just said, okay, well, we're going to include pub and food together and we'll have the hotel separately, yeah, you split between the two, but then you don't truly know why the pubs are growing as such. You could probably do the same for hotels as well, in a way, where you might want to be like, okay, how much rooms are we renting out for basically on individual customers where they come in and buy it, or how many are booked in advance, for instance, and you can really narrow it down. So I suppose this is a great thing for the operations of their business, because if they simplify the organization, there's less stress, less hassle trying to really put the pieces together, and it could be a good sign for the future, because the management of this company has been questionable as of late, making that 50 billion euro bid for GSK's consumer arm, and they said they're not going to rise it, but they're also on about so that some of their brands were of a lower quality and they were looking to perhaps remove of it, which I agree with, don't get me wrong. If you've bought some bad businesses, that's diversification, and you can't obviously recover the operations of the business and do well with it, then you should absolutely get rid of it. But in this case, they didn't seem confident in their own products, and they were willing to overbid for products of a competing company. Tiny Build PLC, they deliver a few video games. Their main video game franchise is Hello Neighbor. That's now crossed 100 million downloads. They said contribution from acquisitions is also ahead of expectations, and that their performance is also ahead of expectations in the second half of the year. There's no real figures here, but in their portfolio and pipeline, they've mentioned Potion Craft, which is a new title of theirs, has had over 500,000 downloads and had reached number 1 on the Steam's top sellers chart at launch in September 2021, which is an impressive feat. No doubt Steam is a very large platform that I would say, I think in my opinion, is probably the most popular platform for video games. Yes, obviously you've got the Microsoft Store, you've got the PlayStation Store, but they're limited to consoles. Steam being pretty much the most popular option on a computer means that is a very, very strong performance and is a good sign to see. Obviously it would just be for the month, but again, to reach that, showing that you've got brand awareness there, and Hello Neighbor in the past has done very well for that. Very popular game on Steam as well, or at least it was a good few years ago when it first came out, and so there is, again, something of note. They've said that they've increased their staff from 147 to now over 400, and this is from the time of their IPO, which without researching, I can't quite remember when that was. I think it was a good few years ago now, but that is certainly showing some good growth, and that they're growing the idea of, actually, you know what's great, I'm going to check when they IPO'd. What am I doing here? TBLD IPO. Actually, you know what? If I just go share price for TBLD, we will then see if we go to here. So they IPO'd actually on the 12th of March to increase their overall headcount from 147 to 400 in that time period. Whilst the shares haven't really done anything, suggests that there is some good underlying growth of the business, but at the same time, their price to earnings ratio, at least according to Google Finance, which is hit or miss in my opinion, is actually very, very high as well. And I think it's sentiment, to be honest, in the industry, which is perhaps what is on factor right now, where I think the sentiment and valuations for these video game developers has been very high following the acquisitions of some of our UK-based companies like Codemasters, and I believe there was another one, was it Sumo Group as well? So it may mean that at the moment they're very, very pricey. But to see that they are growing could be a promising sign. It's just a case of, if you were to invest in the video games industry, what type of brands do you go for? Do you go for the big parties like EA, Activision Blizzard, that was going to be acquired by Microsoft, or it is, I don't know what's going on with that at the moment, Or do you go for the smaller ones, the one that develop the indie games on a lower budget, but these video games still have the potential for the same reach? I don't know if you've realised, but a lot of the really popular games that become noticed amongst the community are usually ones that aren't what you would expect. So you might go, oh yeah, Call of Duty Vanguard is out or something, right? But you'd expect that because they release a Call of Duty each time. But then suddenly out of nowhere, there's this game called Fall Guys or Among Us, and you're like, wait, what? And it becomes extremely popular. The budget on it was very, very low, so there's a lot of lucrative, perhaps, value there if you're able to find a company that has got worth of their game. So if they make a good indie game at a low budget and that becomes very popular, then there is very, very, very high growth potential for the businesses. I hope you enjoyed this update. If you're interested in how to make £1,000 a month in dividend income, then click the card at the top right of the video. Thank you for watching. Have a fantastic day.